Coming up in today's show, stocks rise and yields fall after the surprise attack on Israel from Hamas militants. I take a look at the knock-on effects to all key markets including oil, gold, the Fed and interest rates, defense stocks, and the risk of this spilling over into something bigger. Hey, what's up guys? I hope you're doing okay, and what a dark weekend it has been for the world. I'm sure you've all been seeing the horrible images coming out of Israel. And politics aside, I'm sure we can all agree it's a really sad situation to see innocent people and civilians getting slaughtered. And wouldn't it just be great if the whole world could just get along? However, that's not the reality right now. And so today, being a financial markets channel, we're going to talk about how this relates to markets and what it could mean going forward for some key assets. So the surprise attack on Israel from Hamas militants initially spooked markets, as one would suspect. S&P 500 gapped down 20 points. However, we finished a bit higher across the board. There was more pronounced moves in the commodity market, with crude oil futures gapping up over 4% and holding on to those gains, currently sitting at $86 a barrel. And we got a bit of a bid in gold as well, which is now holding at $18.64 an ounce. The bond market was closed this Monday in observation of Columbus Day. However, yields did fall. We did still have bond ETFs trade, and the implied yield on the 10 year is now 4.63%. The worst performing stock sector should come as no surprise. Global jets and the airlines travel stocks, they finished down today on average 2.5%. We got a strong bid in energy and oil and gas stocks, and should also come as no surprise that defense stocks were the winner today, up almost 4.5%. And stick with me because I'll get into these a bit more on the charts and where we could go from here. Let's first just step back and take a look at the whole situation and see what we can make of it. So obviously this is a very active, ongoing and fluid situation over there, as Israel, the only Jewish country in the entire world, surrounded by over a dozen Arab countries, most of whom want to see their complete elimination, with the most powerful being Iran leading the pack, helped the Hamas militants from the Gaza Strip do a surprise attack Saturday morning on Israel. And like we've unfortunately seen in all the videos, they're not just targeting military assets and army men, they're going after civilians as well. And that sparked a big response from the Israelis, with Prime Minister Benjamin Netanyahu declaring war after receiving the biggest attack on their people in over 50 years. And they're obviously conducting a heavy response in the Gaza Strip and basically looking to turn the place into a parking lot. So just in analysing the effects on markets, the first and most obvious one is oil. With a lot of the world's oil coming out of the Middle East, it's no surprise we got that spike today. However, what's going on over there right now shouldn't have a material effect on the supply and demand of oil around the world, as there's no oil fields in the line of fire right now. There is a small risk that this spills over into a regional conflict. Maybe Iran could get pulled into it, but I'd say probably not. America's already moved significant military assets close to Israel to try and create some stability and deter any possible further aggression from Iran or others. And just looking at the daily chart of crude oil futures, no doubt the market's pricing in that small probability. Things could get worse, hopefully they don't. However, technically speaking, it looks like we've had a solid bounce off this support zone, and this is most likely going to help keep a bit of a floor and tailwind under the price of crude. And like I said, this is just an ongoing situation the market's going to be paying close attention to, and hopefully it doesn't spill into anything bigger. But unlike the 1970s, this isn't as risky for the States anymore, as they're now actually the world's biggest oil producer. However, like you can see in this chart here, we've still got a lot of the world's production coming from the Middle East, with Saudi Arabia, Iraq, United Arab Emirates and Iran some of the top producers. And so any conflict in the region does threaten supplies, distribution and potentially demand as well if it gets bad enough. The other markets have an effect on is that of gold. Seen as a flight to safety asset in times of geopolitical stress, this too is an asset that's gapped up pretty hard on the daily chart here. From that support we're already watching and expecting it to hold around that 18.30 an ounce level, where it had become a bit technically oversold. Even if things settle down over there, sometimes the market just needs a reason to change its tone, and this could keep going, and before we know it, we're back over 1900 an ounce. And unfortunately, war is good for the industrial military complex, with the Army Secretary already urging Congress to pass more funding to quickly give both Israel and Ukraine the weapons and munitions they need. And that's going to keep your tax dollars flowing towards the defense stocks, as it's very likely this conflict could go on for months, maybe even years. And Israel's already asking the US to help out. And so it's likely the defense stocks are going to see an increase in orders and be sending some weapons and ammunition over to Israel. And again, similar pattern on the daily chart of the aerospace and defense ETF under ticker ITA. Traded really strongly today, up 4.5% on triple average daily volume. And looking under the hood, it was companies like Northrop Grumman, a producer of aircraft systems, leading the way up 11.5% on huge volume, and others like Lockheed Martin up a big 9% on volume as well. So this conflict benefits all of the war dogs out there, and even if things were to completely calm down by tomorrow, which highly unlikely they won't, this will still lead to an increase in spending and sending of weapons and supplies over to Israel, as the US is a strong alliance and will step in to back them up where needed. And some are saying the Israel-Hamas war could even change what the Fed does about interest rates. And the market's already responded to that, with bonds trading up today and yields coming down, and that once again is a flight to safety. Whenever we see these international events, US Treasuries are still seen as the safe haven, and we can see that on the daily chart of the Treasury Bond ETF TLT, traded up 2.3% today, from this really technically oversold level. However, that was on below average volume because, like I said, the bond market is closed today, so it'll be interesting to see what bonds do tomorrow when they open back up and whether those lower yields hold or not. And speaking of bond yields, we're already seeing some government officials like Treasury Secretary Janet Yellen coming out with remarks to try and calm the markets amongst the worst collapse in US bonds in their 200-year history. Long-dated bonds bought 3 years ago are now worth about 45 cents on the dollar, and rates are only at 5%. This is already the worst bond bear market of all time, and that's because we're coming off that super low 0%, which we'd never been at before in history as well. And this could still have further to go. There's no reason why rates can't hit 6 or even 7%. And just looking at this table over here, we can see the aggregate bond index. It's already been in 38 months of drawdown, already more than double the longest last drawdown back in 1980 of 16 months. And the index comprised of short and long dated bonds is down 17%. However, don't forget the biggest impact on the returns you'll likely earn from bonds is correlated with the starting yield. And like we can see in this bar chart here, the higher the starting 10-year treasury yield, the higher the 7-year forward bond returns will be. Split up into deciles, with the first being rates between 1.5% and 2.8%, the average annual forward 7-year return is 3.2%. Contrasting with the top 10% of starting yields above 11.5%, the forward returns are a huge 13.2%. That's because the higher yields are, the more likely they are closer to the top and the more room they have to fall. And then when yields fall, bond prices increase. And looking back in history, over the last 50 years, we're still not even in the middle of starting yields at 4.6 and 5.6%. So the average annual returns going forward for the next 7 years can be expected to be around 5.7%. However, like I said, yields could still go higher over the next year or two. Okay, now over to a bit of commentary of what some billionaires are saying all about this situation. First being Bill Ackman, the famous hedge fund manager. And he said, why did Hamas invade Israel last night? Because the United States has consistently not kept its word on its foreign policy commitments and we look very weak. He goes on to say terrorism loves a leadership vacuum and we have created one. The world has now become a much more dangerous place because we have not kept our word. This needs to stop now, or dare I say, hell is coming. The world is a much safer place when the US leads, and it quickly can become a living hell when we fail to do so. And of course, always take what he says with a grain of salt, as he's known to talk his book up, so he's probably already long defense stocks, or something like that. The next is from SPAC huckster Chamath, who said Biden drained the SPR to help push down US CPI when oil looked like it was going to $100. How does oil not spike again? Now on the back of two hot wars, Israel-Hamas and Russia-Ukraine, and a 1.5 million barrel production cut by OPEC, with an SPR that is at the same level it was in the mid-80s. The next is from Ed Yardeni, who said geopolitical crises in the Middle East have usually caused oil prices to rise and stock prices to fall. Much will depend on whether the crisis turns out to be another short-term flare-up or something much bigger like a war between Israel and Iran. Another one from Russ Mold, who says the wider risk is that a sustained increase in oil prices would act as a renewed inflationary pressure and further underpin the higher rates for longer message, which investors in the equity and bond market seem to be belatedly coming to terms with. And then we have a further two comments saying pretty much the same thing, that there's risk for oil prices and further upside inflation from that. So why I think stocks held on pretty good today is right now it doesn't pose a great risk to the future earnings of American companies, and that's what the stock market trades off. However, the risk is if it spills out into more of a regional conflict in the Middle East, and that is a real risk, as I don't think extreme Islamic Arab militants are going anywhere, and they're burning hate to see the only Jewish state of Israel wiped out. So it is a real risk this could spill over, and then the stock market would likely react to that with a big sell-off and further upside in oil. However, we'd also likely see a flight to safety in treasuries, which could keep yields low as well, and could completely change the whole dynamic going on in markets. However, for the sake of innocent civilians, hopefully that doesn't happen and things do calm down. But I think the end game here is probably Israel expanding their grapple on their original homeland, and this is just their chance to completely wipe out Hamas militants and take full control of the Gaza Strip, West Bank, but that's probably going to upset Iran a lot, and they may respond to that. And a conflict between Iran and Israel would likely pull in the States, and that could have much bigger implications across the world. And let's not forget about Russia, who's watching this closely, and this most likely benefits them, because there already is a great divide in America over how much taxpayer money is going to Ukraine. And then if the states have to send a lot of money over to Israel, that could be spreading the budget pretty thin, and US leaders might lose more political support for all this funding of other countries' wars when there's already major problems on the US southern border. However, I don't want to get too political on this channel. I know there's a lot of strong opinions out there on both sides. I'm just going to keep it to risks and how it could flow on to markets. However, it is well known that the United States is a sworn enemy by Iran, who calls it the Great Satan, is well known to sponsor terrorist groups, and their leadership openly calls for the elimination of Jews and America. And some are saying this could be linked to the deal the United States leadership just recently approved. And basically that was the swap of 5 US citizens detained by Tehran in exchange for 5 Iranians held in the United States. But on top of that, President Biden approved $6 billion of Iranian funds that had been frozen from Trump to be released back to them. However, it was supposed to only be used for food and aid. However, anyone can realize if they've got billions of dollars more for food and aid, it just frees up more budget to fund terrorism. So I'll just leave it with you to determine who won that negotiation and what allowing Iran another $6 billion does for them going forward, because that's the real risk here, Iran getting pulled into this conflict, and that's what we'll be looking at going forward. And there's already evidence out showing that they did help plot the attack on Israel, and like I said, it's a fluid situation. We'll just have to wait and see how they respond to Israel now wanting to flatten the Hamas militants. Moving on to economic data, we didn't have much out today. A few Fed speakers who came out a little bit dovish. Going into tomorrow, we've got some more Fed speakers. Wednesday, we got inflation data out of Germany with some PPI data, then the big one Thursday, CPI core inflation rate. Headline inflation expected to increase 3.6% year over year. That flight to safety today caused markets to increase their chances the Fed has finished hiking their rates and is going to stay on hold now. Now only a 1 in 4 chance the Fed will hike in December. Even though stocks rallied today, it was still on shaky ground here with the fear and greed index at 30, and still no love from corporate insiders in this market, with their purchases continuing on the downtrend, and they are not buying the dip here. Looking at international stock indices, they were pretty flat for their start of the week. Not too much action going on there. The VIX index initially gapped up to 19.5, but only finished slightly higher at 17.6. Not much of a reaction from option dealers, still only demanding 4 full points of premium above realized volatility, and a little bit of improvement in breadth, a third of all stocks above their 20-day average. But we've still got that negative breadth trend of more stocks hitting new lows versus new highs. Mega cap tech's the new safety trade. That's why we got those growth versus defensive sector spreads holding up. And we even had a strong move up in high yield bonds today, reclaiming the support zone we've been watching. Dollar index just holding on there below 106. Didn't get much of a reaction in the crypto market. Bitcoin down a little bit. And overall, the commodity complex was up 2%. We've got bump ups in silver and nutty gas. And over to stock sectors, most finished in the green today. Of course, it was global jets. Travel stocks the most affected. Did look to put in a bit of a hammer dip buy candle formation. And just looking at the defensive sectors, healthcare, staples, and utilities all finished a little bit higher as well. There's a daily chart of ExxonMobil and Chevron both popping up. And the big stocks, Apple, Microsoft, and Google all holding on pretty good. The only big one to come off was Nvidia down 1%, and Tesla still coiling up on low volatility. Not much to mention over the meme space, was a bit mixed there. And there's a look at the Israel ETF of stocks. A pretty thinly traded ETF that was down almost 5% today, and the Saudi Arabia ETF down 2.3%. We'll keep an eye on them going forward. And I had a subscriber ask me on Friday afternoon to look at the stock Viasat under ticker VSAT, and they're a $2 billion market cap company. And basically, you could think of them as a competitor to SpaceX in offering satellite-based internet, and the stock has been beaten down really hard this year. And we can see that on the monthly chart as well, trading back at prices not seen since 2009. And just looking at my stock fair value indicator, it's got fair value at $36, saying it's undervalued by 56%. However, my business quality score is slightly negative, which means they may be having some issues with some profitability, efficiency, and margins, things like that. So this stock is interesting, but does for sure warrant further research. So I don't have a strong opinion on it right now. There's a look at some of the food stocks we've been watching. Walmart, Mondelez, and Nestle, and some of the other old economy stocks I like down here. General Motors, Walgreens up today with earnings in 3 days, and 3M potentially looking to put in a short-term bottom, and the banks all having an okay day as well, trying to hold these short-term lows. Okay, there's the S&P 500 at 43.35, seeming to bounce off this trend line again. And as always, interesting times in the markets. And that's why no indicator, person, system, or strategy can ever predict with 100% accuracy what's going to happen, because there's unforeseen events like we saw over the weekend that just affect markets. And like I said, the greatest risk going forward will be Iran getting pulled into it. If they don't just want to sit there and watch Israel completely flatten the Gaza Strip, there is a risk it could spill out into something bigger, and that's what we'll be watching going forward as a key risk in this market. However, for now, if that doesn't happen, things should calm down, markets should calm down. And another thing I'll be watching tomorrow when the bond market opens is whether these lower yields hold or not, what sort of price action we get out of the bonds tomorrow. And other key markets like crude oil we'll be watching as well. As the higher we go on crude, that keeps the squeeze on consumer and inflation. But technically speaking, stocks held on pretty good here after gapping down. And I wouldn't be surprised to come up and tag this 50-day VWAP this week. Do a gap fill, as markets are often attracted to do. Back up to 4,400 on the SP, which would be about a 61% retracement from this recent swing down, and take us back up to that golden pocket where I'd expect stock prices to stall out unless we got a really big pullback in yields. I think stocks are likely to find some overhead resistance up there. Other than that, the other big thing is CPI out this Thursday. And like I said, hopefully this conflict doesn't spill over to anything bigger. And politics aside, hopefully no more innocent civilians are hurt. So that's all for today. Hopefully I can bring you some better news tomorrow, and we'll see what happens when the bond market opens back up. Alright guys, until then, take care. Cheers.